Credit spreads are signaling a major uptick in stock prices. We've gathered some pretty compelling data, vividly illustrating exactly how the markets behaved the last time credit spreads reached their current position. You're going to understand the following crucial points. What are credit spreads? How do they work? What is the connection between credit spreads and the stock market? And why their current position is actually so unusual? It's been several years. What is a credit spread? The difference between the yield of two different debit instruments with the same maturity but different credit ratings. For our purposes, credit spreads are the difference in interest rates between corporate bonds and government bonds. They are a key indicator in market sentiment and risk appetite. For example, the average high yield 10-year bond pays a 7.4% yield, and the 10-year U.S. Treasury bond pays 4.3%. The spread between the two yields currently stands at 3.1. Now, why would this relationship between the two bonds change? Let's consider the condition under a strong economy. High yield bonds pay 7.4%, Treasury bonds pay 4.3%. We've established the spread between the two is 3.1. Now consider the conditions under a weak economy. Yields will naturally decline, but high risk bonds, also known as junk bonds, will also offer a premium in yield because they do entail more risk. There's always a risk a corporation may default on a bond issue, especially during poor economic conditions. So the market will have to offer a little bit extra in yield to attract investment capital. Here, the high yield bonds are paying 6%. Conversely, in a weak economy, Treasury yields will decline more. Here we see Treasury yields have declined to 2%. The spread between the two issues has widened to 4%. In short, credit spreads shrink in strong economies, credit spreads widen in weak economies. So let's go to the charts. In white, the S&P 500, present day. In blue, high yield credit spreads. The inverse or opposite correlation is very clear. Currently, credit spreads have declined down to around a 3% level. We're going to see two examples where, in one case, the market turned almost perfectly at the 3% credit spread, and in another case, the market rocketed higher at 3%. First example, we'll go back to the strong markets of 2019. On October 3rd, 2018, credit spreads hit lows just above 3%. Simultaneously, the S&P 500 touched swing highs just above 2,900 before a tremendous sell-off. In this case, high-yield credit spreads near 3% turned out to represent an ideal time to exit stock positions. For our second example, we're now going to go back to the red-hot markets of 2007. On December 8th, credit spreads hit 3% as the S&P 500 broke above 1,400. But in this case, credit spreads declined to 2.41, while the S&P 500 rocketed higher, breaching 1,500. There's an old premise in market analysis. The market moves in cycles, and the last stage of the trend is usually the most explosive, fueled by the euphoria of investors who don't want to miss out on the action. This stage of euphoria very well may occur as credit spreads break below 3%. Remember our prior example. Credit spreads broke below 3% in December 2006 with the S&P 500 around 1,400. By June, the S&P broke well above 1,500 as the spreads plummeted to 2.4%. That represents a 9% rally in stocks in just the last 6 months of the trend. So now we pose the question to you. What do you think? Let us know in the comments. Do credit spreads bounce here just above 3% as they did in 2019? Is this effectively the top of the entire bull market in stocks? Or do credit spreads break below 3%? Could we actually see prices begin to accelerate from this point? There are a multitude of issues we must consider. The markets more than ever represent a sea of opposing forces. Most of the time we find ourselves somewhere in the middle of the charts, but occasionally we reach an important pivot point and time for decision. Does the current trend continue and even strengthen, or is this one of those magical turning points we will look back on for a long time to come? One huge issue is the state of our housing market. We dove into the details from a unique angle. You'll probably find our analysis quite revealing. Join us as we strive to understand the data for all its fascinating complexity.